Hello everyone, our lesson for today is all about Gaap or Generally Accepted Accounting Principle. Gaap also refers to a common set of accounting principles, standards, and procedures issued by the Financial Accounting Standards Board or FASB. Public companies in the US must follow Gaap when their accountants compile their financial statements. Gaap is also a combination of authoritative standards set by the policy boards and the commonly accepted ways of recording and reporting accounting information. And it aims to improve the clarity, consistency, and comparability of the communication of financial information. Gaap may be contrasted with pro forma accounting, which is a non-Gaap financial reporting method. Internationally, the equivalent to Gaap in the US is referred to as the International Financial Reporting Standards or IFRS. IFRS is currently used in 166 jurisdictions. Gaap helps govern the world of accounting according to general rules and guidelines. It attempts to standardize and regulate the definitions, assumptions, and methods used in accounting across all industries. Gaap covers such topics as revenue recognition, balance sheet classification, and materiality. And the ultimate goal of Gaap is to ensure a company's financial statements are complete, consistent, and comparable. This makes it easier to investors to analyze and extract useful information from the company's financial statements, including trend data over a period of time. It also facilitates the comparison of financial information across different companies. Now, there are 10 general concepts that lay out the main mission of Gaap, or it is also called as the 10 principles of Gaap. So the first five are principle of regularity, consistency, sincerity, permanence of methods, and then non-compensation. So what are these first five principles? So the first one is principle of regularity. In this principle, the accountants has adhered to Gaap rules and regulations as a standard. Second is a principle of consistency. In this principle, accountants commit to applying the same standards throughout the reporting process from one period to the next to ensure financial comparability between periods. Accountants are expected to fully disclose and explain the reasons behind any change or updated standards in the footnotes to the financial statements. Number three, principle of sincerity. In this principle, the accountant strives to provide an accurate and impartial depiction of a company's financial situation. Fourth is principle of permanence of methods. In here, the procedures used in financial reporting should be consistent, allowing a comparison of the company's financial information. The fifth principle is of non-compensation. Both negative and positive should be reported with full transparency and without the expectation of debt compensation. So next five are the principle of prudence, continuity, periodicity, materiality, and utmost good faith. So number six, principle of prudence. This refers to emphasizing fact-based financial data or representation that is not clouded by speculation. Number seven is principle of continuity. While valuing assets, it should be assumed that the business will continue to operate. And then number eight, principle of periodicity. In here, entries should be distributed across the appropriate periods of time. For example, revenue should be reported in its relevant accounting period. Number nine is principle of materiality. Accountants must strive to fully disclose all financial data and accounting information in financial reports. The number 10, principle of utmost good faith, derived from the Latin phrase "obere me fide," used within the insurance industry. It presupposes that parties remain honest in all transactions. Now let's go to the compliance with GAAP. If a corporation's stock is publicly traded, its financial statements must adhere to rules established by the U.S. Securities and Exchange Commission or SEC. SEC requires that publicly traded companies in the U.S. regularly file GAAP or GAAP compliant financial statements in order to remain publicly listed on the stock exchange. GAAP compliance is ensured through an appropriate auditor's opinion, resulting from an external audit by a certified public accounting firm. Although it is not required for non-publicly traded companies, GAAP is viewed favorably by lenders and creditors. Most financial institutions will require annual GAAP compliant financial statements as a part of their debt covenants when issuing business loans. As a result, most companies in the United States do follow GAAP. So this ends the first part of GAAP. So I will be uploading the next part about GAAP versus IFRS. So have a good day, everyone. GAAP is focused on the accounting and financial reporting of U.S. companies. The Financial Accounting Standards Board, or FASB, an independent nonprofit organization, is responsible for establishing these accounting and financial reporting standards. The international alternative to GAAP is the International Financial Reporting Standards, or IFRS, set by the International Accounting Standards Board, or the IASB. IASB and the FASB have been working on the convergence of IFRS and GAAP since 2002. Due to the progress achieved in this partnership, the SEC, or the Securities and Exchange Commission, in 2007 removed the requirement for non-US companies registered in America to reconcile their financial reports with GAAP if their accounts already complied with IFRS. This was a big achievement because prior to the ruling, non-US companies trading on US exchanges had to provide GAAP compliant financial statements. Now, there are some differences that still exist between both accounting rules of GAAP and IFRS, and this includes the LIFO inventory, the research and development cost, and reversing write down or reversing write downs. So, in LIFO inventory, while GAAP allows companies to use the last in, first out, or the LIFO, in short, as an inventory cost method, it is prohibited under IFRS. Now, in research and development cost, these costs are to be charged to expense as they are incurred under GAAP. Under IFRS, the cost can be capitalized and amortized over multiple periods if certain conditions are met. And lastly, in reversing write-downs, GAAP specifies that the amount of write-down of an inventory or fixed asset cannot be reversed if the market value of the asset subsequently increases. The write-down can be reversed under IFRS. As corporations increasingly need to navigate global markets and conduct operations worldwide, international standards are becoming increasingly popular at the expense of GAAP. Even in the US, almost all S&P 500 companies report at least one non-GAAP measure of earnings as of 2019. The Standards and Poor 500, or simply the S&P 500, is a stock market index tracking the performance of 500 large companies listed on stock exchanges in the United States. It is one of the most commonly followed equity indices. Now let's go to the special considerations of GAAP. GAAP is only a set of standards. Although these principles work to improve the transparency in financial statements, they do not provide any guarantee that a company's financial statements are free from errors or omissions that are intended to mislead investors. There is plenty of room within GAAP for unscrupulous accountants to distort figures. So even when a company uses GAAP, you still need to scrutinize its financial statements. Now, where are generally accepted accounting principles used? GAAP is a set of procedures and guidelines used by companies to prepare their financial statements and other accounting disclosures. The standards are prepared by the Financial Accounting Standards Board or FASB, which is a non-independent nonprofit organization. The purpose of GAAP standards is to help ensure that the financial information provided to investors and regulators is accurate, reliable, and consistent with one another. Now, why is GAAP important? GAAP is important because it helps maintain trust in the financial markets. If not for GAAP, investors would be more reluctant to trust the information presented to them by companies because they would have less confidence in its integrity. Without the Without the trust, we might see fewer transactions, potentially leading to the higher transactions cost and a less robust economy. GAAP also helps investors analyze companies by making it easier to perform, or apples to apples, comparison between one company and another. Now, what are non-GAAP measures? Companies are still allowed to present certain figures without abiding by GAAP guidelines, provided that they clearly identify those figures as not conforming to GAAP. Companies sometimes do so when they believe that the GAAP rules are not flexible enough to capture certain nuances about their operations. In that situation, they might provide specially designed non-GAAP metrics in addition to the other disclosures required under GAAP. Investors should be skeptical about non-GAAP measures, however, as they can sometimes be used in a misleading manner. Now that ends our topic for about GAAP. So in conclusion, GAAP is a set of accounting principles set forth by the FASB that US companies must follow when putting together financial statements. GAAP aims to improve the clarity, consistency, and comparability of the communication of financial information. GAAP may be contrasted with pro forma accounting, which is a non-GAAP financial reporting method. The ultimate goal of GAAP is to ensure a company's financial statements are complete, consistent, and comparable. And there are 10 key concepts that guide the principles of GAAP. So that's the end of our lesson. Have a good day, everyone.